This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Up until now, our studies have been devoted to personal taxation, specifically those personal taxes that impact on most taxpayers during their lifetime, i.e. income tax and, of course, capital gains tax. We will see a little later on a further personal tax that impacts upon individuals, and that's inheritance tax. But for the vast majority of taxpayers, that only impacts at one, very sad point in time. Yep, when you die. But more of that later. But now what we can turn our attention to is probably next to income tax, the next biggest part of our syllabus in terms of exam significance. Corporation tax now. Now then, corporation tax, apart from having individual objective testing questions in section A, testing out this area, will also have one of the two 15-mark guaranteed section C, those written questions, those constructed response questions. So it's a most significant area, and one therefore that we must be able to deal with very competently indeed. Let's have a little look therefore at what's involved in corporate tax. To begin with, we'll find that it's a lot easier actually in terms of its construction and the preparation of a corporation tax computation than the various problems that we faced when dealing with an income tax computation. So let's get into now the detail of chapter 16 here, I should say, and our introduction to corporation tax. First thing we've got to know about corporation tax is who pays it, and what we'll be told here is that the scope of corporation tax, here we can see in section 1.1, is that the companies that pay it are companies resident in the UK. So UK resident companies will be chargeable to corporation tax, and they're chargeable on their worldwide income and gains. Now, so far as our F6 syllabus is concerned, we don't have an issue here about overseas aspects. We've only got to look at our UK profits that arise. At P6, advanced taxation, should you choose to go on to do it, lots of lovely overseas aspects of personal and corporate taxes come into play there. But a UK resident company will be chargeable to corporation tax on its worldwide income and gains. But of course that begs a question. And what defines a company as being UK resident? Now, one very obvious aspect is if it was, again you'll see it here, incorporated in the UK. So if you're dealing with A Limited or VPLC, you've got either Limited or PLC after them, it has been incorporated within the UK. That makes it UK resident, therefore all of its profits will be chargeable to UK corporate tax. But what you might have is a company that, although incorporated overseas, is still classified as UK resident based on this second criteria, and that is that it is centrally managed and controlled from the UK. Centrally managed and controlled from the UK. So we see a company, for example, A Inc. So it's not A Limited, it's not A PLC, it's A Inc. or any other designatory letters you may care to put there. But usually Inc. would be the one used in a question. Now that will imply that it's incorporated not in the UK, i.e. overseas. However, it will still for UK corporate tax purposes be classified as UK resident and therefore be subject in full to UK corporate tax on its worldwide income and gains if it's centrally managed and controlled from the UK. What do we mean by that? What we're talking about here is who manages and controls a company, the directors. So if we see that the majority of its directors live in the UK and, for example, board meetings are held in the UK, then that's the sort of evidence that we're looking at. Now again, at this level it will be very clear if this is going to be tested as an issue. And again, it is something certainly based on past exam questions anyway, that could be tested in discursive form, maybe in that written question in section C, to define which companies are chargeable to UK corporate tax. They are UK resident companies. What is a UK resident company? Either one incorporated in the UK or one that is centrally managed and controlled from the UK. What do we mean by that central management and control? look at the directors, whether the directors live where our board meetings held. So, once we have deemed a company to be UK resident, it will require the preparation of a corporation tax computation. And in preparing that corporate tax comp, there are three basic definitions that we need to be familiar with that will be relevant to us in the preparation of the computation. Now, if we get a Section C question that asks us to prepare a corporation tax computation, what you will be given in the question is the statement of profit or loss, our profit and loss account, our income statement, call it as you will, the statement of profit or loss. And a company may prepare its statement of profit or loss for any period of time that it chooses. And here is our first definition, what we call a period of account. The period of account, quite simply, the period for which the company prepares its accounts. Now, that would usually be a company year-end. It will, once it's up and running, prepare accounts for a normal year-end date. But a period of account may be other than 12 months. It may be shorter. It may be longer than this. Now, why and where would that happen? Well, it would, of course, happen, no doubt, when a company either commences or ceases to trade. So when a company starts to trade, it doesn't necessarily choose a date exactly 12 months later to which it will then forever prepare its accounts. It might start trading on the 1st of August and decide that December is its chosen accounting period end date. So its first set of accounts, therefore, would be a short period, probably a short period, through to the following 31st of December. What it might do is to start trading on the, let's say, 1st of November and decide that the 31st of December is its chosen accounting date, but thinks, well, 1st of November, it's only 2 months to the next 31st of December. I don't want to be preparing accounts for just a short 2-month period, so we'll run an opening period of account of some 14 months and go through to the following 31st of December. So we may face this situation on the first period when a company starts to trade, or of course, and very likely to be, when the company ceases trading. It's very unlikely that the company will choose to cease trading on what is its normal accounting year-end date. So either the first, the opening period, or the final period of account, the period for which the company prepares its accounts, may be other than 12 months. When else might this arise? It might, of course, arise whenever it has chosen, for whatever good reason, to change its accounting date. It might, of course, have been taken over by another company, and therefore what the other company does, now its parent company, is to bring its accounting date into line with the parent company. So we see a change in accounting date. So the period of account, the period for which the company prepares its accounts, normally a year end, but it may be less than, it may be more than 12 months. That is the document that usually we start from within the question. They give us the statement of profit or loss. Now what we're going to have to do, and again you remember I asked you to look at chapters 4 and 5, the adjustment of profits and capital allowances chapters that we dealt with when looking at the unincorporated trader, to look at those in preparation for what we do now in corporation tax. For you will have to, for the statement of profit or loss, adjust up the profits. So we'll have to do an adjustment of profit process for the period of account. And the idea is that the period of account will then form the basis of preparing the corporate tax computation. But now comes in our next definition. Because the corporation tax is charged and corporate tax computations are prepared, not for periods of account, but for chargeable accounting periods. Now, as I say, not for periods of account, but instead for chargeable accounting periods. Normally, they are one and the same. Normally, as we say here, a company's chargeable accounting period, again we'll abbreviate that to CAP going forward, will be the same as the company's period of account. But there is one important rule here for us to know, that when we prepare the corporate tax computation, It is prepared for a chargeable accounting period, and the chargeable accounting period cannot exceed 12 months. So, if the period of account that we prepare is for a 12-month period or a short period of account, no problem. The period of account becomes the chargeable accounting period, and for it we prepare the corporate tax computation. That will mean, therefore, that we will prepare the statement of, or from the statement of profit or loss, we'll prepare our adjustment of profit, and we'll also compute and deduct the capital allowances for this, the chargeable accounting period. The only time we have a problem where we see that the period of account is other than the chargeable accounting period is if the period of account exceeds 12 months. We know that we may have a long period of account. I suggested just a few minutes ago that maybe a company starting to trade on the 1st of November and choosing 31st of December as its chosen accounting date may indeed decide, therefore, to prepare a first set of accounts not for 2 months to the next 31st of December, but for a 14-month period. So if for whatever reason we have a long period of account, then we must prepare from that 2 corporation tax computations, because what we have learned, this vital point here, is that a chargeable accounting period cannot exceed 12 months. So a long period of account will require us to prepare from it 2 corporate tax computations. The first one always will be for 12 months, and the second will be for the remainder of that period. With our example, with our 14 months to the following 31st of December, we'd have a 12-month period followed by a 2-month period. Now, the detail here of how we deal with that in terms of adjustment of profits, capital allowances, and how we take one statement of profit or loss and divide it between 2 corporate tax computations, not as difficult in fact as we might think, but that we find in the next chapter, in chapter 17 there. What we need to do here in chapter 60 is see how to prepare 1 corporate tax computation. Once we've been able to do that, then we'll see how to prepare indeed 2 corporate tax computations. Okay, so the period of account, the period for which the company has prepared its accounts, the chargeable accounting period, normally the same as the period of account, but it cannot exceed 12 months. If the period of account is more than 12 months, we divide it into 2 corporate tax computations, the first always of 12 months, the second the balance of months there. The third definition, a financial year. The tax rates to be used are corporate tax rates, or in fact now, as we'll discover from FY financial year 15, the tax rate, but what used to be the tax rates to be used, they are set by HMRC for financial years. And financial years run from April the 1st through to the following 31st of March and are denoted by reference to the year in which they start. So if we talk about financial year 2015, it begins on the 1st of April 15, denoted by reference to the year in which they start, FY15, 1st of April 15, through to the 31st of March 16. Now what these are for, the Chancellor, HMRC, sets the rates of tax by reference to the financial years here. From financial year 2015, however, there's just a single rate of 20% for corporate tax. No matter what size of company we're dealing with, no matter what level of taxable total profits the company has, all companies, whatever level of TTP, we'll talk about that later, taxable total profit. Whatever the level of taxable total profit, all profits across the board are taxed at 20%. Now, this was not the case until financial year 2015, with effect from 1st of April 15. But for purposes of our F6 exam, students will only need to know this 120% rate. So irrespective of whether an accounting period spans 2 financial years or is all within 1 financial year, it will not matter. We will simply use a 20% tax rate. Now, although that means, and for those of you, if you've done tax before, you will have seen that in the past, companies were defined for determining their relevant tax rates as being small or marginal or large. And those terms now are redundant in all but one sense. Although whatever level, whatever size of profit we have on the chargeable accounting period, there is only one tax rate, the universal 20% tax rate, to apply. It's still going to be important to know whether a company is actually, under our old and still new terminology, is defined as being a large company. So despite the introduction of the single universal rate of corporate tax, necessary to determine whether a company is a large company. And the reason for this is that large companies, as we'll see in a later chapter, is required to pay its corporation tax through what we call the quarterly instalment payment system. This means we'll be paying tax earlier than would otherwise be the case. Companies with profits that would make them large companies are required to make quarterly instalment payments. That means, and all we need to know at this point, is that they will be paying their corporation tax much sooner than other size of companies would pay. So when do we know that we're dealing with a large company and therefore quarterly instalment payments are required of us? Now, we'll just get introduced to the issue here. The detail of it and how quarterly instalment payments work, well, that awaits us in a later chapter when we deal with the administration and the payment of corporate tax. But a large company is a company whose profits exceed 1.5 million. Now, that 1.5 million is based on a 12-month accounting period, and the profits to which we refer are defined as. Now, there again, I used this term a moment ago, but we'll see it on the pro forma corporate tax computation in a few minutes' time. We look at the taxable total profit of the company. That's your bottom line figure on your corporate tax computation. It's the taxable total profit of the company plus, here's a lovely term, franked investment income. FII is the accepted term for that, the acronym that we use, franked investment income, FII. And what franked investment income is, it's computed as the gross equivalent of dividends received, gross, this is an exercise you're used to from income tax, dividends received times 100 over 90. It's the taxable total profit plus franked investment income, dividends received times 100 over 90, but excluding in that calculation any dividends received from companies we refer to as related 51% group companies. More of that in a moment. But let's look at what we've got here. We're saying that the profit that we compare with the £1.5 million limit to decide whether the company is large or not, and therefore whether quarterly instalment payments are required to be made by the company, that we compute that profit as the taxable total profit of the company, the TTP, the bottom line figure on the corporate tax computation, plus FII. And FII, dividends received times 100 over 90, the gross equivalent of dividends received. We exclude from that dividends from related 51% group companies. But it also tells you one other important lesson at this point, and that is that dividend income from any companies is exempt from corporation tax so far as UK resident companies are concerned. We will not find dividend income on the face of the corporate tax computation in determining TTP, taxable total profits. Dividend income is exempt from corporate tax. But although it is exempt, you do not pay corporation tax on dividend income. I repeat, it is exempt from corporate tax. What we see is that in adding it to the taxable total profit, the figure of profit to be charged to corporate tax at 20%, that when we add that figure in, if that takes the profits above 1.5 million, then it means that the company is a large company, as once upon a time we would have known it. But the relevance now, it may require the company to pay its corporation tax much sooner than would otherwise be the case, i.e. under the so-called quarterly instalment payment system. All right, so we must compute, therefore, what is the TTP of the company for the chargeable accounting period. We must add franked investment income, dividends received other than from related 51% group companies, which, as you'll see in a moment, is basically subsidiary companies. We add in the FII to the TTP, and we compare with the £1.5 million limit. That will determine whether the company has to or does not have to make payments of tax using the quarterly instalment payment system. That will be its significance, relevant to whether it will actually use the quarterly instalment payment system. Okay, now we mentioned there about related 51% companies. Now they're going to have another impact here, but companies are related 51% companies where one company controls another, or two or more companies are both 51% subsidiaries of another company. For this purpose, dormant companies are excluded here. So we're basically talking about group companies. Groups defined by, does a parent company own more than 50% of the shares in its subsidiary company? We usually refer to that, therefore, as 51% group companies. So, the significance of these related 51% group companies. We said that we would look at a limit of 1.5 million. But that 1.5 million limit, I should say, that we look at in determining whether the company is going to be required to make quarterly instalment payments or not, that 1.5 million is based on dealing with a single company with a 12-month chargeable accounting period. You remember that a chargeable accounting period cannot be more than 12 months, but it may be less than 12. What we must do, therefore, with that 1.5 million limit in determining does the company have to make quarterly instalment payments, we must, it is therefore divided by the number of related 51% group companies, and that number that is at the end of the immediately preceding chargeable accounting period. And it must also be time apportioned for a chargeable accounting period of less than 12 months. Now we're getting into sort of quite a little bit of detail here, but it's again not a difficult area, and its only significance is when do we pay our corporation tax. That is all. So it's not going to impact on how we prepare the corporate tax computation down to TTP. That will be prepared for the chargeable accounting period. It will include all of our worldwide income and gains, excluding dividend income, because dividend income is not chargeable to corporation tax so far as companies are concerned. But in determining whether the company is, in inverted commas, large and therefore may have to make quarterly instalment payments, the limit of 1.5 million will be reduced in either of two circumstances. Either where we've got a short chargeable accounting period, less than 12 months, where you're simply time apportion. If the chargeable accounting period was 6 months, then you take 6/12 of the 1.5 million limit. That 1.5 million limit must also be divided out by the number of related 51% group companies. The related 51% group companies exist where you have a parent company that has a subsidiary or subsidiary companies in which obviously it owns more than 50% of the shares. So what have we got here? Our example. Large Limited prepares its accounts to the 31st of March in each year. and for the accounting year ended 31st of March 16, it had a TTP of 600,000. Now note there it's prepared its accounts for the year ended 31st of March 16. So the accounts are prepared for the period of account. The period of account is the year ended 31st of March 16. That is a year end. It is not a long period of account. It is not more than 12 months. So the period of account, the year ended 31st of March 16, becomes the chargeable accounting period. For the year ended March 16, we will prepare our corporate tax computation for the year ended 31st of March 16. And in doing so, we have determined a TTP of £600,000. Now, given that the chargeable accounting period is 12 months, there is no time apportionment of the 1.5 million profit limit. We still have that 1.5 million profit limit. So with a TTP of only £600,000, clearly we are not large at this point, we would think, and therefore we don't have a worry about do we have to make quarterly instalment payments. But there's a couple of things that we still need to do. We're told that we received dividends from a number of companies, including its two wholly owned subsidiary companies. This was the lowest profit that it had recorded in several years there. This was its lowest profit recorded in several years. Right. The significance now in relation to these profits and whether or not quarterly instalment payments will be required. We've been told that Large has two subsidiary companies. That means that there are three related 51% group companies. There are three related 51% group companies. So we've got a parent, two subsidiaries. Parent plus two subs is three related 51% group companies, which now means we must reduce that profit limit of 1.5 million by dividing it out by the number of related 51% group companies. How do we do that? 1.5 million divided by 3, so our limit for each of the companies is now 500,000. Well, Large Limited has a TTP of £600,000. So even without including FII, even without knowing which dividends have come in from subsidiary companies and which dividends have not, in order that you can establish FII, and you add FII to TTP to give you the profit figure by which then to compare with your profit limit, it doesn't matter. The TTP at 600,000 is already above the revised profit limit for each company in this group of 500,000. That therefore means that as we exceed that, the company will therefore be required to make quarterly instalment payments to settle its CT liability for the accounting period. Now, why that is and the full detail of it, other than we have just discovered that in fact this company is large by reference to the relevant profit limit, i.e. divided by the related 51% group companies. The detail of that we will see later in chapter 23, where we'll then fully understand, I trust, the quarterly instalment payment system. But let's look at what we have on this page of notes before we go any further. What we have seen is that we are required to prepare a UK corporate tax computation for a UK resident company. What is a UK resident company? One that is either incorporated in the UK or is centrally managed and controlled from the UK. We look at where the directors live, where the directors meet for their board meetings. If we have a UK resident company, then we must prepare a UK corporate tax comp, and the company, as we've said, will be liable on its worldwide income and gains. The question will give you, as the basis of it, the statement of profit or loss. That is the company's period of account. Quite simply, the period for which it has prepared its accounts. Normally that period is for a year, its chosen accounting year-end date. But it may have changed that date, or we may be dealing with the very first or the very final period of account, and it is other than 12 months. So a period of account, though usually 12 months, may be short, may be long. We then move to the second and most important definition of all, that of a chargeable accounting period. What makes it the most important of the definitions is that it is for the chargeable accounting period that we prepare the corporate tax comp. And that corporate tax comp, that chargeable accounting period, is usually prepared for the same as the period of account. They're normally the same. The period of account usually becomes the chargeable accounting period. There is just one issue, and that is this CAP, the chargeable accounting period, cannot exceed 12 months. So as we'll see in the next chapter together, if we have a long period of account, we must prepare two corporate tax computations, and they will always be the first for 12 months, the second for the balance of months. The third and final of these three definitions, financial years. Once upon a time this was important, because from one financial year to another we would have different tax rates applicable, and those tax rates would be different based on the level of profits made by the company. Companies back in the old days, pre-financial year 15, may have had any of three different types of tax rate to apply, based on whether the company was small, was marginal, or large. But those terms no longer have any significance whatsoever, because from FY15, and we are only expected to know the rules from FY15, there is a single universal rate of corporate tax of 20% to be paid by all companies, whether they make £1 of profit or whether they make £1 billion worth of profit. A single 20% rate will apply. Now, although that profit limit of 1.5 million that used to differentiate between which companies were large and which were not, although that is no longer important in the context of the tax rate that the company will be charged at, it is still relevant in terms of when the company will be required to make its payments of corporate tax. And if the company has a profit measured as TTP, taxable total profit, plus franked investment income, FII, if those profits exceed the profit limit of 1.5 million, then quarterly instalment payments may be required to be made, the detail of which, as we've just said, we will see in chapter 23. But that profit limit of 1.5 million will have to be reduced in any of either of two circumstances. Either where the chargeable accounting period is short, it is less than 12 months, when you would time apportion the profit limit. As we said, a 6-month chargeable accounting period would use a profit limit, 6/12 times 1.5 million would be 750,000. But whereas we've seen it in our example beneath, it is where the company has related 51% group companies. These are group companies, related 51% group companies. And in our example, we had a parent company and two subsidiary companies there, two wholly owned subsidiaries. So yeah, we had more than 50% of the shares. That meant parent plus two subs is three related 51% group companies. Divide the 1.5 million profit limit by 3, that gives you 500,000. The company's profit is greater than 500,000 because we know it already has a TTP of 600,000, so without adding in any FII figure, we know that the profit exceeds 500,000, the company is large. This will not affect the corporate tax calculation. The tax will be calculated at 20%. But what it will affect is when the company may then have to pay its tax, and whether or not quarterly instalment payments are required of it. But as we said, more of the detail of that coming up in chapter 23. Over the page now, just as a sort of standalone written exercise that could be required of you, we've had questions in the past at F6 that ask us to state, because of the relevance, the importance of a chargeable accounting period, when would a chargeable accounting period start, or when would a chargeable accounting period end? So we've just summarised what these basic rules would be. A chargeable accounting period will normally start immediately after the end of the preceding chargeable accounting period. It was also, of course, start when a company commences to trade or when its profits otherwise become liable to tax. Now, that is usually when it starts to trade. A chargeable accounting period will normally finish 12 months after the beginning of the period or at the end of a company's period of account. We know that a chargeable accounting period cannot exceed 12 months. So if we have a long period of account, say of 15 months, we prepare a corporate tax computation for the first 12, that is 12 months after the beginning of that period, and we will then prepare another corporate tax computation at the end of the company's period of account, so we'd have two computations, one of 12 months, one of 3 months. A chargeable accounting period will also finish when the company ceases to trade or when its profits otherwise cease being liable to tax, again for us at F6 when the company ceases to trade. So again, in relation to that, you could see, again, it's been tested that way, a couple of marks for stating when a chargeable accounting period would start, a couple of marks for stating when a chargeable accounting period would end, or we could use any of these terms in the context of an objective testing question in section A. Now, what we've said, of course, is that in preparing the corporate tax computation for the chargeable accounting period, what we will need to do is to establish the taxable total profit of the company. And so far as this lecture is concerned, what I want to do first of all is just have a little look at the basic corporate tax computation. Right, here in section 2 of our chapter, taxable total profits. Right, we know that the company's corporate tax liability for an accounting period is calculated by computing the profits, that is the worldwide income plus gains, from all sources, as we've said, and then deducting, here's something new, qualifying charitable donations. So the calculation of the company's TTP will be listing out profits, income and gains worldwide from all sources, and then deducting something we call qualifying charitable donations. That figure will be our taxable total profit. It will then be charged to tax at the single corporate tax rate, the universal rate of 20%. So what goes into the corporate tax computation? Well, where do we think a company will get most, if not the entirety, of its income from? Pretty obviously from its trading activities. That will require two exercises, two computations to be prepared by you potentially in an exam question, both of which you are familiar with from what you did in chapter 4, where you computed an adjusted profit, you prepared an adjustment of profit statement, and chapter 5, where you computed capital allowances. We deduct those capital allowances from the adjusted profit and we get the tax adjusted trading profit. What we will discover in our next lecture together is the few differences that exist in terms of adjustment of profits and capital allowances. What we'll discover is that if anything, the adjustment of profit and capital allowance process computations will be actually easier when dealing with incorporated trades companies rather than when dealing with unincorporated trades, sole traders and partnerships. It'll actually be less work to do. So we get our tax adjusted trading profit for this, the chargeable accounting period. If the company does have other income or gains, then they too must then be included. Now, what other types of income might it have? Well, like an individual, it might have interest income. But here, when working with corporate tax, we work on an accruals basis. It is interest receivable that we will include here. Remember, when dealing with income tax, we looked at interest received. Not so in corporate tax. When dealing with companies, accounts, accruals basis will apply. It is interest receivable. We may also have property income, where again, we work on an accruals basis. The property income accrued less any expenses incurred during the accounting period there. What you do not see, as we mentioned before, is dividend income. Interest income, yes. property income, yes, both being included on an accruals basis for the chargeable accounting period. We do not include dividends. Dividends are relevant. They are added at the bottom here to taxable total profit, as we'll see later, for purposes of comparing the profit figure then computed with the 1.5 million profit limit there to know whether or not quarterly instalment payments may have to be paid. What we also must include here are chargeable gains. Now, from our personal tax studies, I should say, in earlier chapters, we're aware of the basic rules of CGT. What we'll discover is that there's a new element that comes in terms of the corporate tax comp and how it is we calculate that capital gain. We'll see that again in our next session together. But once we've added in our other income and gains to our tax-adjusted trading profit, we have then a subtotal known as total profits, not taxable total profits, though they may prove to be one and the same figure, but total profits. And from that total profit, we then deduct qualifying charitable donations. You may recall that when dealing with income tax, there were various tax-efficient ways by which an individual might give to charity, and that made it a relatively complex area with which to deal. This is so much easier when dealing with corporate tax. With corporate tax, they make qualifying charitable donations, they make gross payments to charity under the rules here for qualifying charitable donations, and that makes them deductions from total profit in deriving taxable total profit, RTTP, and the corporate tax computation is then complete. As we have just witnessed here, note A, dividends received from any other companies, be they UK or overseas, are not taxable. Dividends paid are also not deductible. They are not expenses. So in determining your tax-adjusted trading profit, if you've got dividends paid having been deducted from the accounting profit, that must be added back. Dividends are not expenses. Dividends paid are distributions. Distributions out of the taxed profit of the company. So dividend income is not taxable. Dividends paid are not allowable deductions in deriving TTP. Companies pay corporation tax on their taxable total profit. So they don't pay capital gains tax. They pay corporation tax on both their income and their chargeable gains. Again, we will see the issues about chargeable gains for companies in chapters 19 through to 21 coming up in a few lectures' time there. Okay, I want you to look at and learn that pro forma computation to understand that the computation itself is prepared for a chargeable accounting period. What is the chargeable accounting period? Usually, but not always, the same as the period of account. I've gone through that now several times. I won't repeat myself again, but make sure you've learnt it prior to next time. On the corporate tax comp, for that chargeable accounting period, we must establish trading income. That requires you to do your adjustment of profits. Again, if not already, make sure you revise the basic adjustment of profit rules from chapter 4. We must then compute and deduct our capital allowances. Make sure again you could revise your rules of capital allowance computations from chapter 5. Once done, we've got our tax adjusted trading profit. I will go through with you at the start of the next lecture the basic differences between how we did adjustment of profits and capital allowance comps for unincorporated traders, with basically the easier format of that for companies. Once we've got the tax adjusted trading profit, bring in interest receivable, bring in the property income accrued, bring in any chargeable gains. That will be based on the date that the asset was sold. That will crystallize the gain or loss, and net chargeable gains, gains less losses, will be included here upon the corporate tax comp. That gives you total profits, any qualifying charitable donations that have been paid during the accounting period. The basis for their deduction here paid during the period, they are deducted in deriving TTP. If necessary, if you need to compute the profit figure to determine whether or not the company may be required to make quarterly instalment payments, then you would add in franked investment income. That is the gross equivalent, 100 over 90, times dividends received but not from related 51% group companies. Not from related 51% group companies. So make sure you've learnt that pro forma computation. In our next lecture, we'll go through the preparation of that computation and the issues that we need to know over and above what you learnt before for income tax, most notably in Chapter 4 and Chapter